and inflation continues to hurt American families. Now President Biden and the Democrats are celebrating the Inflation Reduction Act, which he signed into law recently. But how effective will the bill actually be? Here to discuss, we have Tavi Costa, Portfolio Manager at Crescat Capital. Tavi Costa, thank you so much for joining us.
Thanks for having me.
Tavi, yesterday at the White House's Inflation Reduction Act celebration, President Biden defended his big spending by saying, quote, "We spend but we pay." What's your reaction?
Well, I think there's a kind of a lack of understanding from what fiscal spending really does to inflation. Back in the 60s and the 70s, I think there was a general sense from most policymakers that reckless amount of fiscal spending would actually generate inflation. Today, certainly we don't have that. And instead, still deficits are really high. We haven't even seen a recession. When you have a recession in average all the way back to the 70s, we see an increase of deficit to GDP of about 6 percentage points. In the current levels that we are, I think that would be, a very inflationary backdrop as well. So it's, the fiscal agenda has never been so extensive. You have, somewhat of an issue in regards to that, the Green Revolution. You have the peak inequality problems. You have the risk of us having to, or the U.S. having to reduce the reliability with China and other places and having to rebuild an infrastructure plan of the U.S. And so all of those things end up being inflationary, and student debt, loan forgiveness and things like that. All those types of policies tend to be very inflationary. So that fits inside of what we think it's a beginning of an inflationary regime.
Tavi, the stock market did not join in on the festivities yesterday, had the worst day since the height of the pandemic, losing over 1,200 points. What's to make of this?
Well, I think when you look at central banks today are having to really reinforce this price stability part of their mandate. And that means we're not going to see excess liquidity as we saw before. If you look at global central banks today, their assets have already shrank by about $3.5 trillion. You overlay that chart with NASDAQ, it's the same chart. So it's very clear to me that as we continue to see central bank balance sheets shrinking over time globally, that should also have a lot of impact on share prices of the overall equity markets here in the U.S. So it is quite concerning what's happening, and I think will continue to be the case. And it's, when you think about, just put into perspective, back in 2020 during the March crash, the Federal Reserve, today NASDAQ is down close to 30% already from its peak, call it 25 to 30%. The prior times that we saw such a decline, the Federal Reserve was basically completely reversing its policy, meaning either doubling the size of their balance sheet or slashing rates to zero. We're seeing quite the opposite today. We're seeing them increasing rates by 75 basis points or maybe 100 basis points, and on top of it selling or reducing their balance sheet by about $95 billion a month. So that liquidity, withdrawal of liquidity in the system is going to be a big deal.
Now, I see some analysts are predicting a 100 basis points rate hike from the Federal Reserve next week. Is that your expectation?
Well, I don't think I have really an edge to say if it's 75 or 100. I probably, if you put me on the spot, I'll probably say I think we're going to see a 75 basis points increase. But I'm not sure, anybody really knows that answer for that. I do think that sustainably, it's sort of impossible to see much of a much bigger move of tightening going forward. I mean, I do think the global economy cannot handle this level of tightening of monetary conditions and financial conditions. If you look at financial conditions, for instance, they're as bad as they were back in March 2020 today, and we haven't seen the recent lows in equity markets. So all of that should translate into, I think, further weakness in risky assets as a whole. And it's important to see the break of correlations in general. You're seeing treasury markets also suffering along with equity markets. I think if you're a fund or a pension fund in general, which used to hold treasuries as a way of protection in your portfolio, that this is a very, very tough environment. So we're seeing, lots of issues actually setting off in equity markets. It comes from consumer discretionary. It comes from technology companies. We're yet to see the mega cap stocks really suffer, which I think it's the next leg down.
Tavi, we see that retirement accounts have lost trillions of dollars this year because of market volatility. One of our readers has actually complained about the fact that his spouse had to return to work. Do you expect more retirees to be affected in return to work?
I think so. And I think, unemployment rates are lagging indicators. Back in the 70s, we had those waves of inflation. We had the first wave in the late 60s, beginning of the 70s, and then the second wave in the mid 70s, and the third wave in the late 70s. But nobody talks about the actual waves of unemployment rates that follow those inflationary problems. And so usually in average, at least in that inflationary environment, what we saw was that after 2 years of inflation accelerating over 2% or so, starting to accelerate to the upside, it took about 2 years to start seeing unemployment rates begin to move. And we're at about 2 years now since inflation began to move. I believe it was in April of 2020. And so I think we're getting pretty close to a beginning of a move here on unemployment rates. And I think the Federal Reserve can speak their hawkish language as long as unemployment rates remain low. Once we start seeing that start to move to the upside, I think that's going to make their job a lot more difficult.
Tavi Costa, really appreciate your insights.
Thanks for having me.
A comprehensive overhaul of U.S. Taiwan policy. That's what a bill vows to do amid heightened threats from China. NTD's Iris Tao has more on the Senate's latest move on the legislation.
With strong bipartisan support, the Senate Foreign Relations Committee on Wednesday approved a bill that its architects say could overhaul U.S. policy toward Taiwan. Called the Taiwan Policy Act, the bill in its current form would provide $4.5 billion in defense aid to the democratically ruled island. It would also designate Taiwan as a major non-NATO ally and rename Taiwan's de facto embassy in Washington. Here's Senator Kevin Cramer's take on it.
We have to take strong measures to send strong signals to the leadership in China that we are not going to just sort of roll over or sit back, but rather take their aggression very seriously.
While senators who sponsor the bill have said its goal is not to change U.S. Taiwan policy, the White House has expressed concerns over the bill amid increasingly tense relations with Beijing.
There are elements of that legislation with respect to how we can strengthen our security assistance for Taiwan that are quite effective and robust, that will improve Taiwan's security. There are other elements that give us some concern.
And what would you say about concerns that it could hurt U.S.-China relations?
Well, I think that the leadership in China have already made that a high priority. And that is, they've chosen to hurt the relationship. They've chosen to be much more aggressive. We can't simply sit back and not respond.
I can understand that there should be some considerations in regards to that, but if it benefits Taiwan and the United States, then we should do it.
Meanwhile, the future of the Taiwan Policy Act is still uncertain. Upon passage in the Senate Foreign Relations Committee, it still needs to pass the whole Senate, not to mention the fact that there's still not a companion bill to it in the House. But Congressman Steve Chabot tells me that he's hopeful that it's going to bring real changes.
Well, we're glad that the senators are working on this right now. I would like to see something in the House comparable to this. And I think it's far overdue that we do away with this strategic ambiguity.
Reporting in Washington, D.C., Iris Tao, NTD News.